The next Bitcoin blow off top will lead us to over 350,000 US dollars. More than a 3x within the next 12 to 15 months. Today I sit down with Stephen Perrenod. Not a moon boy, not an average pleb like me. He holds a master's degree in astronomy from the Harvard University and a bachelor's degree from MIT in physics. He truly knows his stuff about math and about the world, and he shows us why Bitcoin going up over time and all those price targets that we will discuss are not based on belief, but are based on mathematics and the power law. We also talk about the perfect portfolio size. What size should be Bitcoin? What size should be cash? And does Stretch, the preferred stock of Strategy, has a place in there? And also, how does a portfolio between MicroStrategy and Bitcoin actually look like, and what are the benefits for that? We also talk about gold being a leading indicator for Bitcoin and so much more. And the 4-year cycle, obviously, he has a crazy theory with the 4-year cycle that the 4-year cycle was never there. And he actually shows us in the podcast why it is a complete different thing. So I'm super freaking excited about that. This is an episode you might want to watch twice. Enjoy. Hi, Stephen. Welcome back in 2026 to Bitcoin.
It's a pleasure to be with you again, Robin.
Really cool. I always love our sessions because I always feel like a student again. I feel that actually most of the time in my podcast, because like most of the time my guests are a lot smarter than me, the whole purpose of it. And I really love learning about math, about the power law, about your findings about the market. And today will be really cool. 4-year cycle, the bubble, maybe rising later, the Kelly criteria, Bitcoin versus dollars, the gold comparison, like all of that. Maybe before we get started with all of that, how were you feeling in 2025? What kind of did you see in Bitcoin 2025, now going into 2026? How was the past 6, 7, 8 months for you in Bitcoin since we last spoke?
Yeah, good question. I think it's kind of a setup for the key new thing that I want to present, which is this log periodic nature of the cycles, or the bubbles, if you will. And I would say early in the year, my expectation, like most people, well, we're going to have another bubble sometime in 2025. Maybe there's a pattern here, but I was always a little nervous, and I spent a lot of time late in 2024 and especially in the first half of 2025 studying the nature of the bubbles. How strong were they? How rapidly were they decaying? If you break down the distribution of residuals, it's bimodal, and so you get kind of a core behavior and a bubble behavior, and the core behavior has not changed over the lifetime. That's the core power law, and the volatility in that core really hasn't changed much. But both the amplitude and the volatility of the bubbles has been coming down. So I was worrying more and more, and it always bothered me that 2011 there was a clear bubble, and that everybody ignored it in the whole idea of a 4-year cycle. And then you had very small statistics. So you had 2011, 2013, 2017, 2021, and you basically had 2 intervals that were 4 years. And just based on those 2 intervals, you were assuming a 4-year cycle. And it didn't sit quite right with the idea that Bitcoin is a power law asset. So as we got further into the year, it looked more and more like, we're just kind of staying relatively close to the power law, sometimes a bit above, sometimes below, a little bit too much below. And my conviction that there wasn't going to be a bubble just kind of kept growing. But it was only until the very end of November when I kind of discovered this, and I should say rediscovered it in a way, which you'll see when I present it. Giovanni had touched on it years earlier.
I love that. Let's just directly jump into it. I think you have prepared a little bit for this podcast. Let's talk about golden bubbles. I love that headline.
Okay, and gold is relevant to this gentleman. This guy was master of the Royal Mint. He's also the person that we know about calculus and gravity. That's Isaac Newton. But that was his second job, and he spent just as much time in that job as he did up in Cambridge. I did want to mention that we're forming this scientific Bitcoin Institute. We've now created it, headquartered in California, but we're going to have an office in Italy as well, in northern Italy. And so that's just getting going, and we've got our first corporate sponsors lined up as well. And that's Giovanni Santostasi and myself are the founders of that.
Nice.
So the idea is to really do, scientific study of Bitcoin. Hopefully some of what I present today represents that. So I'll start out talking a bit about Newton and alchemy and energy, and then quickly review the difference between a power law and exponential growth or compound annual growth, and then talk about Bitcoin versus gold, how that's been behaving. I think that's kind of relevant because gold had such a good year and Bitcoin hasn't kept up. So, what's going on there? And then I'll look at the Kelly criterion with respect to Bitcoin versus gold and the Bitcoin versus gold power law. And then the bubbles, if you look at Bitcoin measured in gold ounces. And it was actually doing the analysis of Bitcoin versus gold bubbles that I first came upon this spacing in log time rather than linear time, rather than a regular Fourier cycle. It's a kind of a log time behavior. And then I validated it by looking, versus the dollar. And you see essentially the same thing when measured against the dollar. If we have time, I'll talk a bit about cities versus companies and how power laws manifest there. And then I have an analogy with cosmology and dark energy and dark matter. And that'll be it. So Isaac Newton, we know from calculus, and we know gravity. So that's 1665, 1687 with Principia. But it's not as well known that he was master of the mint for 30 years. And so, he spent about an equal time in Cambridge in academia, and then that was his sort of post-academic job. He was also interested in alchemy. And at that time, the distinction between chemistry and alchemy was not so clear. Chemistry had not really become well formulated. So you can make an analogy between alchemy, or what they were trying to do in alchemy, basically unsuccessfully, and Bitcoin. But alchemy has this idea of a prime material. And for Bitcoin, it's electricity. They had a crucible, a furnace. And for us, that's the ASIC miners. They had this philosopher's stone. So it was the catalyst that you needed to enable the transmutation of a base metal into gold, like lead or something. And for us, that's the Nakamoto consensus. And then the transmutation into the gold is the actual minting of Bitcoin, mining of Bitcoin, the creation itself. And it had also this idea of a quest for immortality and for eternal value. And we know with Bitcoin, we have basically eternal value due to the hard cap and the incorruptible ledger. The idea of encapsulating energy into a digital money goes back about a century. And the first reference that I've seen to this is a Nobel Prize winner in chemistry, a British, Frederick Soddy. And he was interested as well in this idea of energy as money. He published a little pamphlet called Wealth, Virtual Wealth, and Debt. And he noticed that debt grows exponentially. And of course, the fiat money supply grows exponentially. And the US and other government treasury debts grow exponentially. But in the real world, you have growth and decay. And he called for an energy currency because he said wealth originates from energy transformation. Better known as Henry Ford advocating it also in the 1920s. And then later, Buckminster Fuller around the end of the 1960s. And of course, the whole path began probably with David Chaum, 1983. And then it was there's really 40 years of cryptographic research that led up to 2008, 2009. Just a reminder that power laws are quite different from exponentials. Power laws are found everywhere. There are four fundamental forces of nature, and each one of them has a power law component. In fact, both gravity and electromagnetism are essentially pure power laws. And then the nuclear forces, the weak and strong force, have power law components and other components. And here are just some examples. Black hole, it's the simplest kind of relation. A linear relation is the simplest kind of power law of raised to the first power, basically. And the radius of a black hole is just proportional to its mass, which is quite different from the radius of the sun or the radius of the Earth. And if you have two black holes circling around each other and they get too close, the tidal forces will cause them to inspiral. And that the amount of time they have left is very sensitive to the radius. It's the steep power of the separation of the two, the fourth power. And here are a couple of other examples. The last one is the Higgs force, and there you have both square law and the fourth power of something. And it's also notable that discoveries can take decades or a century to realize. So, not everybody is fully accepting the power law nature of Bitcoin. The discovery was made around a decade ago by Giovanni. In order to see the difference between an exponential and power law, just check what kind of plot you're on. Mostly in finance, you're going to see linear plots or log linear plots. So if you're on a log linear plot and you have constant compound annual growth, whether it be 7% or 10% or some other number, that's an exponential. And so that takes the form of price, some constant, times an exponential function with a characteristic time scale. And that T0 in that first line is a time scale to grow by a factor of E, the base of the natural log. Or if people are familiar with the rule of 72, you can think about the doubling time. So if you've got 9% growth, it takes about 8 years to double. 10% growth, it takes about a little over 7 years. But it's going to be a straight line to the extent that it follows that path. And that's not the case with the power law. It has a curve in log linear. However, if you put it into a log-log plot where both axes are logarithmic, then you'll see a straight line for the power law, and the slope of that is the power law index. It's the steepness of the power law. It could be a square law, or it could be a cube law, which is steeper. And in the case of Bitcoin, it's much steeper. It's between the fifth and sixth power. So these things, might be tangential, and if you look at them over a short range, you might say, well, this fits exponential or this fits power law, but you have to look at several orders of magnitude in order to distinguish. Okay, wrong direction. Okay, let's get into Bitcoin versus gold. You can demonstrate very easily that Bitcoin follows a power law when measured in gold terms or measured in dollar terms, and gold against the dollar does not follow a power law. And all I did was take 15 prices, which are the price of Bitcoin and gold, on January 1st for the 15 years from 2011 to, well, in this case, it didn't go quite to 2026. So I did this with a near year-end price for the last one in mid-November. And so in the second column, you have the log of the age, that's log base 10, and then you have the log of Bitcoin's price in dollars. You have the log of gold's price in dollars in the next column, and in the last column, you have the ratio the log 10 of Bitcoin's price when it's measured in gold ounces. And so you can just do this in a spreadsheet and you can calculate the slope. And for Bitcoin measured in dollars, the slope is 5.8. That means it's a power law of the age of Bitcoin raised to the 5.8 power. The R squared is really good. It's 0.96. So you don't need to look at every day of the history in order to extract the fundamental power law nature of Bitcoin measured either in dollar terms or gold terms. In fact, measured in gold terms is just the last column. It's a somewhat less steep slope because gold does go up relative to the dollar. It's a 5.5. But again, it has a very high R squared of 0.94.
But they're very close together, like 5.5 and 5.8. I mean, like it does make a big difference over time, but it's closer than I thought.
Right. Now, if you take the log of gold measured in dollars, of course, you can get a best fit, right? And it's a weak slope, it's 0.29, but it's statistically weak. The R squared is only 0.28 instead of being well over 90 percentile. So really what it is compound annual growth. And that compound annual growth is 7%.
What is
at least over that 16-year period. So R squared is a measure of the goodness of the fit. It's the correlation coefficient, but we take the square of it. That's just the way it's done typically in statistics. So if R squared is 0.96, it means R is 0.98. So the two are correlated positively together at 98%. And the overall R squared, which is kind of the goodness of fit, is 0.96. So it's a measure of the goodness of fit. 0.28 is weak, 28%, which is what you get if you force the fit with gold. But a much better fit is with the compound annual growth rate. It really follows that. Obviously, it did better than that last year. But over long periods of time, gold essentially makes up, measured in dollar terms, it essentially covers the inflation in the M2 money supply, which is also 7%.
Was gold ever a power law, or
Never.
It never was a power law?
No. In fact, gold has had some periods of exponential rise and decay, like when the Spanish discovered gold, in South America, and when the California gold fields were discovered, and then you have a big jump in supply, then you'd have the crash in prices. But over long periods of time throughout the 20th century, it was kind of fixed for the first part until 1933, 34. It didn't vary too much, but after that, it essentially followed pretty well with this. And certainly after the complete cut from gold in 1971, it's very much followed this kind of growth rate. It's had its periods of volatility, but if you take the long term, this is what you see.
It's super interesting because we talk so much about digital gold and comparing Bitcoin to gold, but then you look fundamentally, they really don't move in the same way.
Right. Yeah. And this is just visualizing that. So this is Bitcoin measured in gold ounces. And you can see it's moved from less than 1,000th of an ounce to, now it's about 20 ounces. So how many orders of magnitude is that? That's 1, 2, 3, 4, 5 orders of magnitude that the price of Bitcoin has increased in gold terms since 2011. And you can see that the band is fairly tight there, right? That's the one standard deviation uncertainty, is the blue shading.
And so what do you make of 2025, where gold was really having a rally, like in general a rally, but also against Bitcoin?
Well, I think we saw Bitcoin stay fairly close to its power law with the dollar, but gold clearly outperformed. And so now we're kind of at the, you can see in this plot really, that final X, that we're down at the sort of 1 sigma, minus 1 sigma portion of the band. So it's still within the power law behavior, but lagging. And I think what we saw is that the uncertainty in the monetary regime and kind of larger macro uncertainty has favored gold. And interest rates have been relatively low. When real interest rates are low, that favors gold. And also, typically, gold prices tend to lead Bitcoin prices, usually around 1/4. In this case, it seems more than that, but that's been typical.
Interesting.
This shows
gold is leading the Bitcoin price. Is there like, have you found a reason for that, or is this just like, I don't know where it comes from?
I don't know. I certainly we saw a lot of central bank buying in 2025. India, China, Russia, central banks are buying a lot of gold. They're trying to decouple somewhat from having treasuries. There's, I think there's jockeying going on for what the future dominant global currency will be, right? This shows correlations over the last 4 years. And the blue line is Bitcoin and NASDAQ, generally positively correlated. And the gold line is gold and Bitcoin. And sometimes they're positively correlated, but sometimes they're anti-correlated. And it's much lower than with stocks. And the green one is bonds. But, gold is risk off, right? And Bitcoin often behaves more like risk on, more like NASDAQ. In the upper left, we have the Bitcoin price on the y-axis on the left. This is a log linear chart. And we have the gold price with the right axis, and they're different scales, right? Because in this time interval from 2011 through the end of 2025, Bitcoin went up by over a factor of 100,000 against the dollar. And gold went up by less than 3 times. So yes, gold has done well, but Bitcoin has done 30,000 times better, right? And then the little chart below that is this question of gold leading or Bitcoin leading. And here you want to have a low number. It means that the probability is low that you're seeing some sort of random noisy outcome. The upper line, which is not statistically significant, is Bitcoin leading gold. That's the question that's being asked, and it's saying no. And then the lower line, which is below the red dash line, which is a 5% probability, and it's usually the criteria used with this, says, yeah, gold is leading Bitcoin. And in, the range can be 2 to 13 weeks or so. And then the chart on the right is the rolling 52 period correlation of Bitcoin and gold. And you can see it's all over the place. So don't expect a lot of stability in that, sometimes positive, sometimes negative. All right, this is the regression with more data, more than just annual data points. This uses weekly data points and quantile regression, but ordinary least squares regression is also on the chart. So the solid line is the ordinary least squares best fit, and the green dash line is the quantile regression median best fit. And you can see they're relatively close to each other, and they have the same parallel index of 5.3. The annual data, not as sensitive. We found 5.4, but when we confirm it, we still get, 5.3, and the uncertainty is small, and the R-squared is still very good. Now, if we were at trend, we would expect to be at about 40 to 50 ounces. And right now, we're only at about 20 ounces. Gold is, 4,500, and Bitcoin's just over 90,000. So we're just a little over 20 ounces right now. So let's say there's some catching up to do. And we're actually down a bit below even the 10% level in the quantile regression. So we can't say that the power law is broken, but we're seeing weakness right now. This is another statistical test that's called the Hurst exponent. And it measures how strong your trend is. We do the quantile regression, and then we detrend the data, and we look at the log residuals of price. And then you do this test. And the test says, as I change a window size, how big is the scale relative to the uncertainty, the R being the range and the S being the standard deviation, the uncertainty. And then it turns out that that thing that you measure also actually has a power law nature. And it gives you this exponent Hurst. And the Hurst exponent normally ranges between 0 and 1. And if it's random walk, you expect to see 0.5 for that Hurst exponent. But if it's mean reverting, you expect it to be close to 0. And I did the test on the SPY, which is the Standard & Poor's 500 ETF. And I measured with 10 years of SPY that H is 0.18. So that indicates strong mean reversion. And that's something that has a basically exponential behavior growing roughly at 10%. But if you apply this test to Bitcoin, either measured in dollar terms or in gold terms, either with daily data or with weekly data, you measure about 0.9 for that exponent. Remember, random is 0.5. 0.9 is very, very strong trend. So this shows that we've got strong trend persistence. We've got a highly inefficient market, if you will, or there's real long-term alpha is another way of putting it.
The first thing that every Bitcoiner does, and the most important activity that every Bitcoiner keeps on doing, is buying Bitcoin. And I personally use Relai to buy and sometimes also spend or sell my Bitcoin. And there are two main reasons why I do so. The first one is it's Bitcoin only. They do not do any shit coins. They do not do any cryptos, any stocks or anything else. This is a tool, an app that is fully focused only and solely on Bitcoin. The second one is self-custody. They give you the keys to your Bitcoin the moment you buy them. You never give them the control over your Bitcoin, and you don't have to trust them because you can verify that you and only you have the keys to your Bitcoin. There's no third-party risk. There's no freezing of your assets. There's no rug pulling. There's nothing of that. Download Relai, the app, on your phone, or go to relay.app on your browser and use code Robin to save fees and get cheaper Bitcoin. I want to tell you about something very special to me. It's called MicroSeed. If you hold your Bitcoin in self-custody, and you should, you know how critical it is to secure your seed phrase. You should not have them on paper. You should not have them on anything else than titanium. With MicroSeed, you can engrave your 12 or 24 word seed phrase, the entire seed phrase, onto a 1-inch small washer. Yes, just one washer. All 24 words on that one washer. You can hide that thing everywhere. And even better, you don't need to buy a new kit every time you have to get a new wallet. You can make unlimited backups because MicroSeed is not selling the washer. MicroSeed is selling the device that stamps the washer. So you get the full kit with the device, with the washers, with the hammer, with everything you need to get started today, and you can make with that unlimited amount of backups. Go now to microseed.io. Maybe quickly just to the gold one, because I think it's also what a lot of people say, that like gold has shot up so much in the last year that it's almost like in, if you want to say that way, in a bubble territory. and Bitcoin hasn't caught up with that. And it was interesting because Bitcoin almost is the only asset that really didn't grow a lot in the last year. And this is almost an indicator if the Bitcoin power law in gold is as before. It is basically a very strong indicator of like you shouldn't now sell your gold and get into
Right.
Bitcoin.
Right. Yes. And that actually gets right into this Kelly criterion issue, because you rebalance, when your portfolio. So imagine you had a 2-asset portfolio with Bitcoin and gold. And if you do the analysis, you want to have a lot more Bitcoin than gold, like 3-to-1. But then if you have a really good year, it gets out of whack, right? If it's a really good year for gold. And so, yes, you want to sell some gold, put it into Bitcoin, that's a favorable opportunity. So what the Kelly criterion does, and this comes out of the entropy of information and the work that Claude Shannon did at Bell Labs to define that in order to deal with noise and communication signals. And John Kelly was an associate of his also at Bell Labs, and he figured out a way to apply this to a series of bets or gambling or to financial returns. So and it turns out you can optimize, and there's a lot of math that can go behind it and prove that this is an optimal way to go. There are many research papers written on it, whole books, but it allows you to optimize the growth of the logarithm of your wealth. And that's a good strategy because, it keeps you from going bust, basically. You want to keep growing the log wealth, but you never want to lose, more than half or go bust. So to kind of set that up, here's a table of asset class returns for 10 years, 2015 to 2024. I don't have the table yet that includes 2025, but I will comment on that. But if you take those 10 years, for 8 of them, Bitcoin was the best of these asset classes. And how many do we have here? I think we have 16 asset classes, something like that. And half of them are debt, and they don't return that much. So I'm going to narrow it down to 8 more interesting ones. But Bitcoin was number 1 for 8. The other best one was broad tech. Gold had some good years, some weak years. And of course, as we know, Bitcoin is kind of the worst when it doesn't do well. So it had 2 really bad years when it was the last. And so you're seeing the volatility there. But what you can do is take just those percentage returns of all these, and from that you apply the Kelly criteria, and then you can compute, if you have a 2-asset portfolio, how much you want to put into each. And so I'm just doing this against the dollar. So if you just have Bitcoin and dollar, how much Bitcoin do you want to own? What's the optimal amount? So what he does is he defines a fraction, the Kelly fraction. It's the optimal. It's the maximum. You don't want to invest more, actually, because you won't do as well. If you have a down year, you have a risk of ruin, or a risk of just not performing as well as if you pick this optimal F. And it's a very simple formula, P minus Q over B. It's only 2 parameters because P is the win rate and Q is the loss rate. So Q is just 1 minus P. If we take the 8 asset classes that aren't bonds, so it's Bitcoin, broad tech, small and large caps, real estate, gold, commodities, international equities, and we say, what percentage of the time did they win against the dollar? Bitcoin won 80% and broad tech won 80%. And the others 60 or 70% as indicated. Then the next thing you have to do is calculate this B ratio. You have 2 edges. One edge is if you win more than half of the time, as all of these did. But the other is by how much do you win? Are your wins bigger than your losses? So the W is the average amount that you win in percentage terms for the years that were winning years, and L is the average amount you lost for the years that were losing years. But in Bitcoin's case, we had 2 losing years. They were both, between 60 and 70%. So the average there was 69% or 69.5% loss. The win was 292. B is the ratio of the absolute values. So you take 292 divided by 69, you get 4.2. Then you can calculate your F. You say P is 0.8, Q is 0.2, and you divide Q by B, which is 4.2. So you 0.8 minus 0.2 divided by 4.2, that's 0.75. So what that tells you is if you have Bitcoin in dollars, not earning any interest at the moment, you should put 75% optimally into Bitcoin.
Why not more?
Because it's not optimal, because you have down years. And when you have down years, you want to have some cash so you can reinvest at lower prices, just like you described for Bitcoin versus gold, right?
Interesting, yeah. So you want to rebalance. So like basically you want to be 75% allocated in Bitcoin. So when there is a down year with like 40% or 30% down, the Bitcoin percentage shrinks, your cash percentage rises, and then you rebalance that you are staying with the 75%.
That is correct.
Basically then like you outperform, you then have a year where, I don't know, Bitcoin goes up 50 or 100% or like 300% even, might be now a little bit harder than the last 10 years, I guess.
Right.
And then you can scrim a little bit off the top to get back down to the 75%. Interesting. I love that.
That's the idea. Now, this Kelly criterion is very sensitive to what window you choose, particularly for something that's as volatile as Bitcoin. So this is for annual window or annual rebalancing. And I'm going to show you a quarterly. And with annual rebalancing, you have a higher commitment. And we kind of all know that, Bitcoin is something you hodl long-term, right? Now, if you were to use 4 years as your window, you'd be at 100%. But the problem with that is you'd only have 4 data points. And so you wouldn't be able to do really accurate statistics with only 4 data points. So that's why I've kind of stuck to 1 year analysis here. Now, you can look at the others. Broad Tech does pretty well. You could be 66% allocated. Small caps, not so much, because the losing years were bigger than the winning years, even though it won 70% of the time. Large caps better, not so different from broad tech. Real estate, less. Gold, okay. Commodities, lost on average. International equities, okay, at least in that 10-year period. Now, interestingly, if you adjust for putting money into treasury bills, if you're going to get 4% as your risk-free rate, then all the numbers come down. Because, if you take gold, if your risk-free rate is 4% and you earn 13% average win, then that's only 9% net. And if you lose 8%, well, you're really losing 12% relative to the risk-free rate. So your ratio comes down. So the final column shows the adjusted, which is, in this case, really just the same for Bitcoin, but it comes down a lot for small caps. It goes negative. It says you shouldn't have bought small caps. And real estate, you shouldn't have bought that. And commodities, even more so, international equities.
Interesting. Is real estate in that calculation if you buy it cash completely, or also with, okay, you have a huge leverage on that because like you only put 10% down and like have 90% of it and it kind of boosts your profits?
Yeah, this is unleveraged. This is just REITs. So it's just real estate, through the stock market.
Interesting, yeah. That's really interesting, and it shows kind of the mathematics of why, if you go all into one asset, Bitcoin is probably your best bet, but you should still not do it. And actually, something we've covered in the last few episodes a lot about emergency cash reserve. You can like take your time and like quickly get the phone. But like this is something we covered a lot with like cash reserves and having something outside of Bitcoin also, because if you only have just Bitcoin, you are fast coming in a position where you might have to sell it if you're in a not good situation. Maybe the car breaks down, it's like in a surprise expense, and now you have to sell some Bitcoin. Maybe it's in one bad year, and maybe it doesn't break you, but it reduces your purchasing power. And so the more I think about it, the more it makes sense where not going all into Bitcoin might actually be better strategy long term for maximizing your Bitcoin exposure. I don't know if I could ever sell Bitcoin if we're like on like the highs, because like it's always like, when are we hitting the high? The bubbles can grow faster, but it definitely makes sense of like you never want to be in a position to sell Bitcoin, especially in a down year, and so having cash on hand, being it a few months or like percentages, like however you want to measure that, like 100% it makes sense, even though I'm still building my cash position because I have been all in. I'm just now the last 4 or 5 months starting to build out my cash position also.
Yeah, well, it matters, what your personal situation is and whether you need, other source of income. I'm going to show a slide where instead of using the 4% risk-free rate, you use STRC, which gives you some income. And it's a really interesting slide. Now, I did add in 2025 just for the Bitcoin calculation. So that's shown in the blue on the right. So there our probability becomes 8/11, which is 0.73. And the B ratio actually goes up because we had a small down year in 2025, but it takes the average loss to be much smaller. And so the B ratio goes up. So that kind of offsets partly. And the optimal F becomes 0.68. So it doesn't change that much. If you only look at the last 6 years, then it's somewhat lower. It's about 0.59. Personally, I like to have more, but I like to be more towards the 70-75%. But that's what you'd get if you said, well, I'm going to discount the first 10 years because there were excess returns, and you get 0.59. So these numbers will move around a little bit, and you need to update them. But actually, I'll show you a chart as to how they develop with time. Now, this is interesting. Suppose STRC, which is this preferred issuance that Michael Saylor has done with Strategy, which is kind of a high interest rate money market fund kind of a vehicle. Currently paying 11%. I think it came out at 9 and went to 10. Now he's got it at 11. And he wants to keep the price at $1. It actually moved above $1 today. It did drop for a while when he had the downturn, a couple of weeks ago. But his goal is to keep it close to $1. So if as Bitcoiners, we're probably willing to say that's kind of relatively a risk-free rate, and that might be an alternative for our cash. Well, if you look at Bitcoin and then adjust for that 11%, you still are going to be 74% in Bitcoin, which is interesting. But now the 26% you have in cash could be earning 11% instead of 4%. And even if you drop it down to 5 years, it's like 0.7. But here's what's interesting. Your optimal allocation between small caps versus dollars. So suppose if your portfolio is either small caps or dollars, some combination of two. With an 11% hurdle rate, you shouldn't have anything in small caps. You shouldn't have anything in large caps or real estate or gold or commodities, at least based on that 10-year period, or international equities. They all lose to STRC. So, I put this question in the box. What's the 60-40 portfolio? In the past, the 60-40 portfolio was stocks and bonds, 40% in bonds. Well, now, is it Bitcoin and STRC, 60 or 70 and Bitcoin and the rest in STRC? Or maybe it's tech, Bitcoin and tech, because you can have a pretty good allocation, even with that 11% hurdle rate to broad tech, which is the second row here. I just did this afternoon. It's fascinating that it wipes out all those categories.
So what you're basically saying is having, instead of cash, stretch, which pays around 10%, sometimes 9, sometimes 11, and stays on par. Having that instead of cash, and having then a 60-40 portfolio roughly of like 60% Bitcoin, 40% stretch, is way outperforming anything else.
What I'm saying is fire your investment advisor.
I hope people listening did that, because I think that very sentence has been said multiple times now. But it's crazy. It's like the broad tech means, okay, the F in the last F in green row means instead of cash, you're taking stretch. And then only broad tech makes even a little bit sense to own next to cash, and everything else just like makes no sense whatsoever. Real estate no longer, gold no longer, commodities anyways not.
Look at large caps. That would be the basic 60-40 would be large caps, right? Win rate, 19%. You subtract 11 from that, it made +8 over the hurdle. Loss rate, -11. You subtract 11 from that, you're -22. So you have +8, you have -22. And when you look at it, you'll find out that you wouldn't have won 70% of the time. You would have won less than 70% of the time, right?
The most important thing for your Bitcoin journey is not buying Bitcoin, but it's how to keep them. And yes, you have maybe the right tools, but how do you actually go ahead and stick it all together so it's the most secure for you personally? Self-custody is a deeply personalized journey, and the Bitcoin way is helping you exactly finding that correct setup for you personally. They are also helping you with securing your own cybersecurity. And if you want to go one step above all that, you can even get a consultation for a Plan B residency. Go to thebitcoinway.com/Robin and you will get a 30-minute free consultation. I finally and officially mine Bitcoin. This is not just something to stack more Satoshis, but it's most importantly also to support the network. Individual miners are the ones that keep the Bitcoin network decentralized. And by the way, you get KYC free Bitcoin. That's why I use Simple Mining. I get an actual proper Bitcoin miner. They set it up for me. They repair it if it breaks down. And most importantly, they let me choose the pool and even connect my own full node. I'm completely sovereign and I'm completely in control, and I can sign up with Ocean, no account needed. I just give them a Bitcoin address and then there's mining going on. No KYC, nothing. So if you're ready to mine Bitcoin, go to simplemining.io, tell them you come from Robin, and let's mine Bitcoin together. Would you replace your local US dollar cash with Stretch? I mean, yes, as a Bitcoiner, I think we still like have this. Like we don't see the risk in Bitcoin. Like we believe in Bitcoin. Like we know all that. But there's still like other risks that, of course, like with strategy and like with the company goes into with Stretch. So it's like maybe not true risk free. I mean, nothing is true risk free. The dollar can also collapse. But is that something that you're looking at where you don't want to, if you have this 75% of Bitcoin allocation and the rest of cash, taking the cash rather in Stretch than in actual cash in your bank account where you might earn like a few percent instead of like 11?
Well, personally, I'm doing it. I have a fair amount of STRC. I also own Strategy, which of course has got higher risk than Bitcoin, but yeah.
What's your actually, I think we never talked about strategy on the podcast with you. What is your take on strategy overall as a company and what it holds as a future? I mean, there's the Bitcoin community is very split on that. And I was always the guy, like, I want to have self-custody Bitcoin, nothing else. But in the last couple of weeks, I started to research strategy. And the deeper I look, the more I actually love it. I'm not done yet at all with my research, and I will probably post like a 1-2 hour video on like what my view on the strategy stock is, and also on the preferred stocks. But I have a similar feeling than when I started researching Bitcoin, actually, because I was very skeptical of Bitcoin. I thought it's a scam. And the more I looked into it, the more bullish I got on it. How do you look at strategy?
Well, favorably in general. I mean, he definitely has been extremely innovative with his financial engineering. And, you know, it wasn't like he figured it out all at once, right? They kind of fell into it in stages and developed it, and they learned by, you know, issuance into the market. I've always owned some, you know, for the past several years, probably owned too much last year, right? But the question, I think, is the price. I mean, here with an MNAV at around 1.0, you know, it's favorable. I've never known exactly how much premium it should have. I don't have a view on that. I always felt it's worth somewhat more than the Bitcoin it holds because it's always acquiring more Bitcoin. It can do this financial engineering. So it's a question of they have to be conservative enough, but even larger than that, the market has to understand what they're doing, and the market had a lot of questions about what they're doing. And also, it looks like some people took a run at them, maybe with a little bit of manipulation, perhaps. But overall, it's sound, and the debt ratios have been low, and they've got a long runway, and they added some buffer, you know, by having more cash as a buffer. So I think they're well situated. They clearly are the leaders in this by very much. They own more Bitcoin than the US government and the next three largest holders combined. I mean, that's incredible, right? So this is really, they're leading a financial revolution.
I love that take.
Yeah.
They impressed me very much by how good they can acquire Bitcoin and how many of them they get. I remember being in a space on Twitter when they had around like 100,000 or 150,000 Bitcoin. Not that long ago, actually. It was a couple, like 2 years ago or something like that, or 1.5 even. Like it's not that long ago, actually. And someone came up to the stage and asked, like, do you think strategy will get to 1% of the Bitcoin supply, 210,000 Bitcoin? And I was like, they most likely will get there, but it will probably take some time because it took some time even to get to 100,000. And I was so wrong. It was the first time I'm like, I completely underestimated them. They have now going towards 700,000 Bitcoin. And I thought they will take that time to go to 210,000. So I was completely wrong on that.
Well, there's just a lot of pension fund money and insurance company money that cannot buy Bitcoin directly. And maybe a lot of it also cannot buy master directly. So there's some, sovereign wealth funds, for example, that have bought master directly because they can't buy Bitcoin directly, right? And some countries, just private investors, same situation. But then there are others that have restrictions over what they can invest in. They have to invest in bond-like securities or preferred. So it was a huge untapped market, and they found it. And it's incredible that they've been able to, in 5 years, build up that 2/3 right?
Crazy. But yeah, let's come back to the thing. I love that you put in Stretch also there as a comparison. Like, this is really, really cool.
Okay, this shows the difference between using a Kelly fraction window of 1/4 or 1 year. And so the blue line shows how your Kelly fraction jumps around. And it's, a lot that it jumps around very early on, but then it kind of gets more stable, and it's around 0.6, and then it sort of drifts down to 0.51 as the returns are a little bit less. So if you are rebalancing quarterly, you could put optimally up to half of your portfolio into Bitcoin. But if you're doing it annually, then you can justify putting in up to about 75%. So the window that you choose makes a big difference. And then, it's even lower. If you use monthly, it's like 0.3. So those of us who have been in Bitcoin for a while know that you really shouldn't be short-term trading Bitcoin.
Yeah, I always tell people that come new to Bitcoin, aim for being at least 2 cycles into Bitcoin, like the 2 mining cycles, reward cycles, or epochs, however you want to call it. 8 years. That's like 8 years now in the headline.
Yeah, this is a different method. It's somewhat related to Kelly. It's a different way of doing it. It's kind of like a Sharpe ratio method, but it's more general because it adds skew and kurtosis in the residuals. That's why it's called MVSK, for mean, variance, skew, and kurtosis. It has nothing to do with Musk. 8 years of daily data, and I did it with a 3-asset portfolio with Bitcoin and gold and stocks. And it turns out you should put something like, in that 3-asset portfolio, you could put about 58% into Bitcoin, and the rest would go into gold and stocks. But how much varies a bit on how much you weight the skew and the kurtosis. And that's what these lambdas and betas are. But the kind of thing in the middle, the 58%, is one weighting. If you weight the skew higher, which is this, it's the kurtosis. If you weight that higher, then you have even higher percentages.
So in whatever you're doing, Bitcoin is always your biggest asset?
Yes. In fact, there's another form of Kelly called continuous Kelly, and you can end up getting over 100% allocations with that method. I don't particularly recommend it, but I would say, all in on Bitcoin leveraged. It kind of recognizes the fact that it assumes the fact that Bitcoin's not going to zero, whereas the traditional Kelly criteria, which is called the gambler's formula, allows for the fact that it could do that. But Buffett says diversification is protection against ignorance. Makes little sense if you know what you're doing. I think some of this helps us feel comfortable that we know what we're doing. when we put large allocations into Bitcoin. Diversification is also Wall Street's way of saying, give us some commissions or let us hold your money, right? So
I love that so much. I say that multiple times. It's because everyone comes here and says like, oh, why don't you diversify? Why don't you like have a portfolio with like blue chip stocks and bonds and real estate and all of that? And I'm like, why would I sell the winner to buy the loser? Yeah, cash reserve makes maybe sense. Stretch might also make sense. Strategy might make sense to have some different play, and also it makes sense just from like having something in TradFi. You can borrow a bet against it. Like it's in the TradFi sphere, better recognized. But like, why would I sell my Bitcoin to buy real estate? It just does not make any sense for me.
Compute. Plus a lot of headaches. Yeah.
My parents both have individually a home on it, and so I know they always work on it.
Yeah. Okay. Now we're Bitcoin versus dollar. This is similar to the other chart I showed. It's got both no, this one's only got the quantile regression. Now it does have the ordinary least squares too. Sorry. The ordinary least squares line is the blue line in the middle. And the one that you want to compare it to is the red line, the quantile regression median, which is the 0.5. So you can see they're similar and they converge. I've marked the bubble tops because we're going to talk about those. And I've got the trend forecasts out to the end of the year. So the ordinary least squares would take us to 160,000 on trend by the end of the year, and the quantile regression would give you the same result, basically, 160,000. They have slightly different slopes and slightly different leading parameters. But one is 5.7, the other is 5.8 something. So again, log chart, logarithm of price, and in this case, logarithm of the age in years. So you can see that the numbers are getting closer and closer together. So that's very important.
So I made a prediction in the beginning of the year that this year we might, or like I said this, that we hit 150K. So this could become true.
Yes, we would expect, on trend, we would expect that.
Love that.
And then how to calculate the current percentage growth. What you do is you take the current age, you add 1, and you divide by the current age. You then raise that to the K power, pull out your calculator and do that. And K is that number like 5.7 or 5.8 that you get from the regression fit. You can approximate it. It's actually an expansion. You can approximate first order by K over T. But then there's a second order term, which is a half K over T squared. So if our current age is 17 as of a week ago, and if K is 5.87, which is the quantile regression, then the first order term says 34.6% is the trend increase, and then you get another 6% from the second order term. And so you've got about a 41% outlook on trend. And right now we're below trend. Trend is about 120,000, 115 to 120,000, depending on which regression technique you use, and 40% growth. Now, a little trick here. If you increase the age with this power law, if you take the ordinary least squares index, that slope 5.68. If the age increases by 50%, the price increases by 10 times. Our age is 17. Half of that is 8.5 years. So 8.5 years from now, you expect the price to be 10 times the trend, which means over $1 million in 2034. And then you'd be at age 25 and a half. So the next 50% would be another 12.75 years, another 13 years, which would take you out to 2047. and then you'd be above 10 million. So if you hold Bitcoin, hold it for half as long as its current age is, and the trend for the power law is a factor of 10, a 10 bagger. This shows how the power law has been stable for a decade now. That blue line that has the kind of band around it, you know, we've got the price line is jagged, but then the blue line that's more curvy or wavy measures the power law index only looking backwards in time at any given time. So at 2014, it shot up because we had a big bubble in 2013, and it shot up to 10 as the index, and then it came down to 6 by 2016. And it's been somewhat below 6 ever since, and it stabilized. It dropped down to 5.2 and then picked up, but it's been quite stable, and currently about 5.68 with this method. And that little band is just the uncertainty in the power law index, and that's gotten tighter and tighter as we added more and more data. So it's quite stable. Now, if you I talked a bit about dividing out the bubble and the core. So that's what this does. We take the lower half, all the data that's below trend and all the data that's above trend, and we call the above trend bubble and the below trend core. And then we measure the standard deviation, the volatility. And for the core, it's the green line. It's just 20% basically over its life. But for the up in the bubble, this is a rolling 4-year average. The standard deviation has dropped from over 100% down to today about 37%. So a factor of 3. It's come down very strongly. And you can fit it with the reciprocal, and that's the dashed line. So we're in a territory where, yes, the returns are lower, but the volatility is lower too. So you still have quite good risk-reward ratio. Now, this is some bubble analysis, and it kind of starts to get us into this log periodic message as well. This is a fit to the quantile median regression in the upper chart. And then what I've done is I've modeled the bubbles in terms of their peak and their duration. And I set a threshold. I said, you're not in a bubble unless you're at least 0.2 in log 10, which is about 1.58 times the trend line. So these green triangles only measure when you're above 0.2 in log price over trend, and then they only measure how much more than that you are. And you can see that the power in those has come down with time. If you take the trend out, you get the lower chart, and so it becomes a little more clear. So these are just the residuals. These are the log 10 of the price residuals after taking out that quantile regression trend. And the triangles show the energy and duration above threshold. And you see 4 large ones, you see a bunch of little ones, both up and down. The smaller bubbles, none of them are of much significance. And there have been none since mid-2022. And the 4 major ones are separated by 2.5 years, 4 years, and 3.3 years. And I say 3.3 plus because the 2021 was a double bubble. And so the 3.3 takes you to the left hump, and then about 4 years to the right hump. But actually the left hump was bigger in terms of its deviation from the power law trend. It has a bigger residual. So in some sense, it was the truer portion of the bubble. So already you're seeing some evidence, though, of not a 4-year cycle because of that kind of weaker double bubble behavior.
So it never was a 4-year cycle. It was always like some kind of almost 4-year cycle.
3 to 4, 2.5 to 4. This one's interesting. And this is kind of the backdrop for the analysis of the log periodic power law of the bubbles. But what Didier Sornette is a geophysicist who has developed this log periodic power law and used it to model earthquakes and other geophysical phenomena, but also financial series. And the name is a little confusing because it says power law, and it's got a power law in it, but it's not the same as our long-term power law trend. What it had, and the log periodic says basically that the waves are getting closer and closer together. So typically you would use it to analyze just some smaller portion of a year or two of Bitcoin, if it's in a bubble, to try and understand how the bubble's developing, because the waves get closer and closer together. And if you follow the red dash line, which is the fit, you can see that the peaks are getting closer and closer together. And this is bubble behavior that you frequently see in stocks as well as in Bitcoin. And he's written, he's published research papers on Bitcoin as well with this model. So the idea is that you get this parameter, which is this little omega 8.55, and that's an angular frequency parameter. And it tells you in logarithmic time how these things are getting closer and closer together. And the other thing you do is you calculate a time when, they keep getting closer and closer together. They also, price gets steeper, and then you get a crash because, they get on top of each other and the whole thing fails. It's moving to a critical state, a critical failure state. This is the difference between exponentials. They don't last forever. They're seen in decay, in rise and in decay. So this tells you tries to tell you when you get the transition. I ran this model in July, and I used data from the beginning of 2024 through the middle of 2025. So it's a year and a half of data. And it predicted the peak at 123,000 and middle September. And the actual peak was 125,000, 126,000 in early October. So it's reasonably accurate. And I presented this publicly back in July. Now, so that's that idea. Now, to get into these log periodic bubble spacings, it turns out that Giovanni had taken a look at this in April of 2019, almost 7 years ago now. And he tried to fit the whole long-term behavior of Bitcoin with the model I just showed you, which is really more appropriate for shorter periods of time. But there is a version of it that uses less parameters. And I think his fit used probably less parameters. But what he did was he was able to roughly fit the cycles for the 2011, 2013, 2017 bubble. And because it was log periodic, he predicted that there would not be another bubble until age 18. So the first 2011 bubble is age 2.5. The 2013 bubble is age almost 5. The 2017 bubble is 9. You can see they're stretching out in time, roughly doubling. And so the next one was going to be at 18 years. This is a log chart. You can see the overall power law trend as well with the red line. And you can see the values that he predicted for X and Y, which are the log of the day count from the Genesis block. So I just calculated that, and it turns out to be 17.96 years, 18.0 years. So I've annotated his original chart. It's actually quite incredible because I've now taken another 6.5 years of data, almost 7 years of data to do the analysis, and I get a similar result, slightly over 18, more like 18.5 years. So he had already kind of found that it was not a 4-year cycle, it's more equally spaced in log age, and that the log periodicity is something close to 2, which means that the interval is roughly doubling. Okay, so here's the form that it takes, the equation for it. It's got 5 parameters. This is the the longer term version of the bubble model. The shorter term I showed you is 7 parameters. So it's tricky to use, but this one a little easier. And what we're most interested is the terms at the end that have this omega and phi. The thing that looks like a W is the omega. And that's the oscillation frequency in angular frequency. And you can convert that to a wavelength, which is a distance. And in this case, it's a wavelength in time, not in space, in time. So for just the oscillation portion, we're fitting that. And this is the relationship between the wavelength parameter lambda and the angular frequency parameter omega. It's log lambda equals 2 pi over omega. Normally you'll see lambda equals 2 pi over omega without the log, but this is log periodic. So that's why it looks like that. Okay, a bit detailed, but what we're trying to do is determine what the best fit lambda is. And he had predicted, he had something that looked like roughly 2. Okay, so now I did a full Fourier transform analysis of all the data, and I found lambda equal 2.07. And the first time I did it against gold, Bitcoin and gold. So that's what this chart is showing you. This is showing the Bitcoin price residuals measured in gold ounces as a function of time. This is the linear age. And I looked at the fundamental of lambda 2.07, but I also looked at the harmonics. The first harmonic in frequency, which is the intermediate wavelength, and that's the blue lines. The fundamental are the red vertical lines. And then there's a subharmonic, which is a green line. So that's a slower one, the subharmonic. So people that, play music, you know what harmonics are. You have the C and then the next octave up, another C. That's a harmonic. And the result is that you fit the 2011 bubble, the red line, the 2013 bubble, the red line, and the 2017 bubble, the red line. But the 2021 bubble is not a fundamental. It's a first harmonic, and that's the blue vertical line that's at a little over 12.5 age. The double bubble, that's the 2021. You have some smaller little ones where the first harmonic kind of lines up, but they're not very meaningful. And then the subharmonic, there's a kind of small bubble around 2019 that sort of lines up with that. But the important result here is that the next red line is at age 18.4. And that's 2027 May. That's age 18.4 years. And if you redo this, Bitcoin versus dollar, you get the same result. You get a graph that looks very similar, red vertical lines, and you get an answer of 18.5. So right smack in the middle of 2027. The R squared is very high, 0.94 with Bitcoin versus gold. And the R squared of these fit. And this is a nice clean result because not only do you see it in Fourier transform, you see it visually really back with the work that Giovanni did, but also in the graph I just showed you. The value doesn't drift much. It does drift some. It tends to get a little longer with time. And my thesis here is that what you're seeing is discrete scale invariance. The long-term power law trend we call continuous scale invariance. It's always in progress. The bubbles of discrete activity happening at certain times, logarithmically spaced. So that's discrete scale invariance. And the argument I'm making is that that's due to capital flow that's coming in new hierarchy tiers. In other words, you started out with cypherpunks as investors, and then retail, and the first exchanges and miners. And then eventually you've gotten to treasury companies and ETFs and sovereign wealth funds and governments with their strategic reserves, right? So you have more and more capital tiers coming in, and those are larger and larger. So there's a hierarchy of capital inflow, and that helps to drive these discrete events. And this has a lot of similarities to things that we see in nature with earthquakes, with volcanoes, with financial bubbles, with phase transitions in physics. And the typical values for this lambda are about 2 in all these other cases. So the 2.07 just fits right in a general sort of physical range there. And some interesting kind of numerology here. You can just take lambda and lambda squared and lambda cubed and lambda to the 4th and 5th power and add it to 2009. And that's when you see peaks. 2011, 2013, 2017, and 2027 and 2047 are the predicted fundamental ones.
Interesting. How high has it to go that it qualifies as a bubble in 2027?
I'll show you that. I think I'll show you that. But roughly, if you just look at the fundamental mode, it's about $350,000.
More than a 3x from here. Not bad.
Right. Yeah, 300 to 350, but you can get spiky behavior if you get, the bubbles don't explain, this doesn't explain everything. This is intrinsic structure within Bitcoin in the way that it adapts to capital inflows from higher and higher tiers, larger and larger amounts of liquidity that gets directed into Bitcoin. It does not account for kind of external stochastic stuff where you have herding, derivatives, options being used, leverage increasing, that kind of external stochastic behavior, which can kind of jump on top. It might not happen or it might happen, but can jump on top and drive more spiky behavior. And we typically see this kind of spiky behavior in these peaks. So once you activate, people kind of come in, right? They can't resist. That's the nature of bubbles in human psychology. So if we compare the Fourier model to the log periodic model, the Fourier model ignored 2011, but the log periodic model addresses it. The log periodic model says 2021 was a first harmonic. The Fourier model said we should have had a bubble in 2025, but it failed. But the log periodic model explains that we didn't have one. And for 2027, you would not expect a bubble with the Fourier model, but we do expect one with the log periodic model. So we'll find out if I'm right, in 2027. But the Fourier model is right 3 times, wrong 2 times. And we've been right 5 times and wrong 0 times so far. And the RMS error of how much, these red lines and blue line, how much they varied from there. For the Fourier model, you're off by over a year as the average error, but for us, we're less than half a year. So the scoring on the timing and the root mean square error is superior. I don't have the curve here. Sorry about that, but if you just take the fundamental mode, you would expect to be at just under 200,000 at mid 2027, but the fundamental would take you up to about 350,000. And I have tweeted that one out, so it is out there in my X feed. How are we doing for time?
We do have another 20 minutes, 30 minutes.
Okay, so I'll go into the cities and companies a little bit. I recommend people take a look at this book, Scale by Jeffrey West. He's physicist, started out, I think, in particle physics, and started exploring the behavior of networks, the physics of networks, and the physics of scaling in biological systems, but in cities and companies as well, which are anthropological systems, right? He was president of the Santa Fe Institute. I think he's an emeritus now. Very interesting book. But for people that don't have time to read the book, go look at this YouTube. Search for Why Cities Keep on Growing and Corporations Always Die. And I think it's a TED Talk, but it's maybe it's not a TED Talk. It's an hour-long YouTube presentation that Jeffrey West gave. Okay, and this is the research results that he published in 2015 with some collaborators, looking at the lifetime of companies. 25,000 North American companies, 60 years of data. These are log linear charts and they're straight lines, so that means exponential. And what he's plotting is the fraction of firms that survive 10 years, 20 years, 30 years, 40 years, 50 years. And you can see it falls very steeply. So if we look at the right diagram, you know, it runs from 3 down to 0. That's a factor of 1,000 because it's log base 10. And you can see how steep it's falling. And it's, you know, an exponential, it's compound annual decay. And the average lifespan that he found, exponential average life, is 10.5 years. So companies are either acquired, bankrupt, spun out, go private. These are all publicly traded companies. Very low percentage survive 50 years. A fairly low percentage survive, you know, more than 20 years. And I suggest this also applies to altcoins because they're more like companies or consortia. Bitcoin is unique. It's there's a name for it. I can't think of it right now, but it's a set of one. So that's companies. They don't behave like power laws. But cities do behave like power laws. And Bitcoin we can think of as kind of a decentralized megalopolis. It's reached a scale of 2 trillion. Its annual market cap value on trend is increasing at like 800 billion. So that's kind of a GDP. And it's going to quickly grow doing compounding. This year, it might grow 1 trillion. There are only 7 cities that have a larger GDP than that: New York, Tokyo, LA, San Francisco, Seoul, Paris, and Chicago. Bitcoin is a meta network of power laws. And we know about the power law of price, but there's a power law of adoption. There's a power law of hash rate. And there are other power laws that you can find when you look at things like the distribution of wallet sizes. So it's a metaphor, but it works well to describe a vast, interconnected, influential digital ecosystem. You didn't need Chat 5 to realize that, even Chat 4 realized that. It's also the most valuable software code ever, perhaps. Windows and Office, that's 2 pieces. Actually, that's a lot more than 2, right? Office is, I don't know, 6, at least 4. Over 3 decades, they acquired 2 trillion in revenue. So many millions of lines of code. Google search and ads, 2 trillion. It took them 2.5 decades. Bitcoin, clearly the most disruptive, reached 2 trillion market cap in 1.6 decades. It's very, very compact code. I forget the numbers, like 30,000 lines early on or something. You may know, but it's quite a bit larger now, but it's still very, very small compared to these others. I think this is my next to last slide. This is a cosmology analogy. So a little background, this pie chart. We have known about dark matter, or at least the first discovery of dark matter was in the 1930s by Fritz Zwicky, looking at the Coma cluster of galaxies, and he saw that the velocities were much too high. And so he said there has to be more matter in there somehow. The matter that you could infer from the galaxies and how bright they were and the mass to light ratios of stellar material, came up short. So he said there's dark matter. He called it Dunkelmaterie. He used the German for that when he first defined it. And it was confirmed in the 70s with galaxies, the way they rotate, that they rotate a lot faster on their edges, including our own Milky Way, than you would expect. And we've now learned that the ratio of dark matter to normal matter, which is just the atoms that you and I are made of and that the stars are made of, is a ratio about 5:1. And it's detected in the cosmic microwave background details as well, with the same ratio of 5:1. Now, dark energy was something that was first postulated by Einstein over 100 years ago. And when he wrote the equations of general relativity, there was no cosmological constant term. But he later added that term because he wanted to try and create a model of a static universe. It turned out to be unphysical because if you just perturb it slightly, it has to either expand or collapse. And it was shown in 1929 by Hubble, the Hubble Space Telescope is named after him, that the galaxies in general are receding from one another. The universe is expanding. So we've known that for nearly 100 years. And the first solution of Einstein's equations of general relativity was in the early 1920s, and then independently, somewhat later in the 1920s, by Friedman first and later Lemaitre. And so we've known that the universe is expanding since then. And then the question has been, what's it made of, right? When I got my PhD in astronomy, we knew there was dark matter. We knew there was normal matter. We didn't know how much dark matter. We didn't know how much really matter there was in the universe exactly. We didn't know if there was enough to halt the expansion. We were that uncertain. We didn't know the Hubble constant to a factor of 2. Now it's all known really accurately because of the very high quality instrumentation, both ground-based and satellite. And only in 1998 was it discovered that the cosmological constant term that Einstein had put in 100 years ago was actually correct. He added it to the equations of general relativity, and it represents a minimum energy of every unit volume of space. It's called dark energy because it has negative pressure, so it behaves unlike ordinary matter. And it's actually a kind of anti-gravity. And it wasn't important early on, but as the universe has expanded, our universe gets thinned out. So the dark matter becomes more sparse and the normal matter becomes more sparse, less dense on average. The galaxies are just there, they're gravitationally bound, but the space between the galaxies grows. And every unit of that has dark energy assigned to it. Every meter has about the equivalent of 4 proton rest mass energy. And by now, it turns out from the results in 1998, which have now been repeatedly confirmed, that it's about 70% of everything. If you use E equals mc squared, that dark energy content of 4 GeV. And so I make an analogy with Bitcoin, fiat, and gold. And the analogy with gold is normal matter. It's ordinary matter. And it was known first. It was the first kind of standard money. I mean, we had seashells was sort of money, 0.0 or grain or other things. But gold has been around monetarily for thousands of years. It dilutes relative, with expansion because its supply increases. It's tangible, so it's like ordinary matter in that sense. And then I make the analogy of fiat money with dark matter. It's elusive but pervasive. You don't see it, but it kind of runs the world, right? It sits there on ledgers, mostly as digital. It dilutes. It's kind of hidden in plain sight because it's digits on balance sheets in commercial and central banks. Dark energy does not dilute. Every unit volume has it. So over time, its dominance grows. When the universe was a tenth its size, dark energy wasn't important. When the universe is twice as old as it is now, it'll be even more important. So Bitcoin is like that. It's displacing dark matter and normal matter, or gold and fiat, as it were, with time. Now, we're not at this stage with Bitcoin where we're 69%. Right now, we're very small. But this is, if you make this analogy, this is the direction. The dark energy eventually wins out. So when could it start to win out? Well, we're at 2 trillion cap, roughly 1.8 trillion. And the US M2 money supply is around 22 trillion. When will they cross? So that would be, in the analogy, it would be dark energy catching up to dark matter, the fiat. And gold, you know, it's going to be a somewhat different date. It's going to be sooner. But it looks like 2036, if you have 7% annual growth of M2, which is the long-term growth rate, and if we go on the power law, we could catch up to the US money supply sometime in the late 2030s, and the global money supply in the 2040s. The global money supply is about 5 times larger than the US money supply. I think that's my last slide.
Awesome. I love it. Twitch, you're a stoic. There was so much in there. I'm always overwhelmed, to say the least. But it's really cool to see that how Bitcoin behaves. There's actually frameworks to think about that, and there's actually patterns there that we see, that there's actually some mathematics behind that, because I think a lot of people feel it's random. They feel it just happens how it happens, and I think it's good for a lot of people to see it's not as random as it might seem to be. We have, as you know, one question to ask each and every one of my returning guests on the podcast. And the question is, what have you learned outside of Bitcoin since your last appearance on the podcast?
Oh. I'm so absorbed in Bitcoin. Well, you know, I do keep up with AI, and I now use AI. You know, I first programmed a computer around 1969, 1970, assembly code on an IBM small mainframe. And I was a Fortran programmer for many years, and learned a few other languages along the way. But, you know, I got into technical sales and marketing in the supercomputer industry, and I didn't do any coding for decades. And now, really only thanks to AI, I'm able to code again, because I'd never studied Python. I didn't know it. I mean, I can read it. It's just another form of code, and it doesn't look that different from other codes. But the problem with these things is, well, you have to know all the libraries and the formatting. You know, it's kind of the tedious side of it, in terms of getting all the naming of structures and knowing which libraries to call and so forth. And so it's been very useful to use AI to generate the code and even learn how to read it better. And even as a sounding board for the model, gee, what if we did this? What do you think? You can use it as an intern or a research assistant. And the quality of the coding has increased really incredibly over the past year, the leap to 5.2. When I first started with it, with 4.0, mostly ChatGPT, I had to iterate so much to get it to do right and to fix error and the next error and the debugging. And now sometimes it will just generate the right code right away. And other times, not so much, but it's incredible how much it's advanced and how useful it is. So I love it. And it allows me to, to do these things and to produce some very nice charts that I wouldn't have known how to do, or that would have taken me weeks. So I've learned how to use that, as a research assistant more and more.
I couldn't do all the things that I'm doing right now without AI. It's almost like, and I think you also use ChatGPT a lot. I also use ChatGPT as mostly. I do always think around with Gemini and Grok and other ones, but like I keep coming back to ChatGPT as my main anchor. But it is so interesting how 3 years ago, I wasn't even aware of it. And now, if it doesn't work, a lot of my workflows and a lot of the things that I do, I would need to figure out how to do it again. It's like completely disrupts my workflow. Like it became a very strong part of my professional life mostly. I know a lot of people also use it for private life. Like I use it less for private life. I mean, health things sometimes, like health advice, and like if I break my ankle or something like that, like how does the foot look and stuff like that. But like I mostly use it for professional and less private reasons.
Yeah, I do find that I don't search much with Google anymore. I just go straight to chat just for random searches.
I don't even know when I last Googled something. And this was crazy. If you think about 3 years back, to say like, oh, I never Google, like it's unthinkable to say something like that, because like you Googled all the time something. Yeah. But really cool. We have another end routine in the podcast where the previous guest is asking a question for the next guest without knowing who the next guest actually is. And the previous guest asked you the question, what would you tell your 18-year-old self as advice?
Is this the 3 words? Because if it's the 3 words, it would be Apple, Amazon, Bitcoin.
Yeah, that's true. I mean, Bitcoin wasn't around when you were 18, I think. But like Apple and Amazon maybe already?
No. No, Apple was not around when I was 18. I was a sophomore in college when I turned 18 my, freshman year, second half.
What was the year there? Like
69, yeah.
Oh gosh, yeah. You were 18 before. You were like at 1969, you turned 18.
Yes.
Gosh, my father wasn't even born at that time.
Yeah.
That's crazy to think about. But yeah, thank you so much. I appreciate you coming back on the show, Stephen. It was really, really cool. Before I let you go, where can people find you and your work?
Yes. On X, Money or Debt, and then on Substack, which is just first name, last name, substack.com. Yeah.
Awesome. Thank you so much. And also thank you so much for everyone that is watching and listening, for joining us today. As always, I'll be back tomorrow with another episode. Bye-bye.
Thanks, Rob.
This content is for educational and entertainment purposes only and does not constitute financial advice.